Here are 5 important KPIs that I track in my business, and I think you would benefit from tracking in your business as well. Now, the first one is CAC, or customer acquisition cost. Now, this is a very important metric to track because it allows you to identify how much it actually costs you to acquire a new customer. Now, this means that somebody was out there in the world, you didn't know them, they didn't know about you, and then it obviously costs you some money to market yourself, to present yourself to them, to get them to become your customer, right? All of that takes money. And so what is that actual cost? And so you can calculate that by taking the amount of money that you spend to acquire customers and then dividing that number by how many customers you have. So that'll give you a rough calculation on approximately how much you're spending per customer to acquire that person as a client. Now, that's an important metric because you can play around with that and see if you can get more efficient with that, right? If you're spending less money per customer, that means you're doing something right. That means your marketing is working. There are things working in your favor. You're gaining some momentum. And remember, the more momentum you have, that number should be going down to a certain extent, right? It's not going to go down forever. It's not going to ever become free to acquire clients. Although, if you have word of mouth referrals coming in and stuff like that, you are going to get some clients for free. So that, of course, is factored into that number, but it does tend to go down the more momentum your business has. So that's a metric that you should be tracking to see when and where it goes down and what causes it to go down. Because if you can find out what's causing that number to go down, then you can start doing more of that thing that's causing this number to go down, because obviously we want it to be cheaper to acquire new clients. Secondly, we want to track our customer lifetime value, or CLV. This is a very important metric to track because you need to know exactly how much revenue that client is bringing in. Because if you are not able to break even on the amount of money that you spent to acquire that customer, then it doesn't make sense. You have a negative cash flow situation. So for example, if it costs you $500 to bring in a new client, right? And maybe upfront, they're paying you $200 for some sort of service. But on average, most of these clients are upgrading to, let's say, $1,000 offer on the back end. They've spent a total of maybe $1,200 with you. So even though you're spending $500 on the client, some of them are coming in and only paying you $200, but the majority of them, or a good percentage of them, are paying the $1,000 upgrade. Now your average is hopefully above $500, right? You're gonna have to do the math yourself, but you have to find out whether that number is more than what you're paying to acquire that customer, because that's gonna affect your profit margins, right? That's a very important calculation that you need to have, and you need to know what it is, because at the end of the day, it's your business, and as long as you can bump that number up and get your CAC down, you're probably going to have a profitable business. Now, of course, if you go on a hiring spree and you start hiring a bunch of people who are not helping you run a more efficient business, well, you could still mess up with your cash flow, but that's when the more complex parts of business. The most simple thing that you need to pay attention to is how much does it cost me to acquire a customer, and how much is their lifetime value to me as a business. Do they tend to stay for 1 year? Do they renew? Do they pay me again? Or maybe they buy some services in addition to what they already purchased, right? You have to do a total calculation on what each customer is worth on average. And as long as that number is higher than the CAC, you're in a good spot and you're probably headed in the right direction. Now, of course, you want to widen that gap as wide as possible, right? It's not always going to be easy, but everything that you can possibly do in business to widen that gap is probably a good idea, as long as it's ethical and legal and all those things. Just make sure you're staying within certain boundaries, but widen that gap. You need to have as big of a gap as possible between your customer acquisition cost and your customer lifetime value. Now, the third thing we want to track, and this is a very important KPI, and that's profit margin. So now we get a little bit more complex. Let's add some complexity to the situation. What about our employees, right? People who are not on the sales team. We have sales commissions we need to pay. We have other operations people we need to pay. We have maybe CSMs we need to pay. We have so many different salaries that we have to cover. We have different softwares and tools that we're using. Maybe we have an office space. Maybe we have company cars, right? We have company trips. All of these things are part of the equation. And so these are all expenses. And so at the end of the day, this is part of fulfillment, right? And you need all these things to, number one, keep your employees happy, to keep them motivated, but also to provide the optimal fulfillment experience for your clients. You have to make sure that they're extremely happy with your product or service, right? You're providing this service to them. They are able to benefit from whatever service you're providing to them. And now that cost is a fixed cost, right? Well, of course, you can change it. You can vary it a little bit, but for the most part, these are fixed salaries that you're paying people. And so these things need to be delivered no matter how many clients come in. And so if you can keep that fairly low, obviously it benefits you as a business owner because that increases your margin. So again, let's go back to our calculation. And by the way, as part of those expenses, your CAC is going to be included in that. It's included in the profit margin calculation. So it's basically your CAC, customer acquisition cost, all your other operating expenses, everything that you spend money on as a business, and that's subtracted from the gross revenue of the business. So if the business made $1 million and your expenses, including your customer acquisition cost, are $700,000, that means your profit margin is about 30%. You've made $300,000 in profit, which you can reinvest into the business and continue growing the company. So that's how that works. Always pay attention to your profit margin. I wouldn't say there's necessarily a healthy profit margin. Every business is different. I know businesses whose profit margin is 1 or 2%, and I know businesses whose profit margin is 80%. It just really depends on what industry you're in and the type of product or service that you are selling. Obviously, that's going to continue bringing your customer lifetime value up and up and up. It's just going to get higher and higher because that customer is staying with you for longer. And the longer you can get them to stay with you, the more money they're going to be paying you for your service that they love so much. And number 5, this is revenue growth. So overall, as an organization, you have a gross revenue calculation. We talked a little bit about that when we were talking about profit margins, but this is basically the amount of money that the business is bringing in. And there are many things that can affect that, but that's an important KPI to track because at the end of the day, I would say your business should be growing at a minimum of 10% per year. Otherwise, your expenses are just going to get higher and higher and higher. There's no such thing as expenses getting less. Unless you're literally sacrificing some aspects of the business and cutting things out very intentionally, your expenses are not going to go down. That's just not a thing. So if you think about your trajectory as a business and it just goes in a straight line, your revenue is not increasing, right? We need it to increase, but let's say it's not increasing. If it's not increasing, guess what's happening to your expenses? Your expenses might be lower, right? They're right here, 700,000, what we talked about. The business is doing $1 million. Expenses are 700,000. Well, guess what? Your expenses are going to go up every year. So now the next year they might be 750,000, and then they're 800,000, and then they're 900,000. They're just going to keep creeping up to that revenue level because you're stuck at $1 million. So your revenue has to increase year after year after year. And whether that means raising prices, providing a better service, creating new offerings or services or products that you can offer to those same clients, you need to figure out a way to raise that revenue. If you're not raising your revenue, at a certain point, you're going to go out of business. And that's actually why most businesses go out of business, because their expenses go up, but they fail to raise their revenue. Alrighty guys, these are the 5 KPIs that I track in my business and I believe you should be tracking in yours. Make sure you like, comment, and subscribe, and I'll see you all in the next video.